This content is brought to you by Link2, which makes private equity investment very easy. Link2 is democratizing the process of being able to invest into tech companies and crypto companies. Previously, this opportunity was only available to venture capitalists, hedge funds, and investment firms. Well, now, if you are an accredited investor, you can get this opportunity before you to be able to invest into crypto companies like Ripple, BitPay, Dapper Labs, Uphold, Abra, and many more. Link2 continues to add these respective companies and their portfolio is growing. So this is a great opportunity to double dip, to be able to hold the crypto tokens such as Ethereum, Algorand, XRP, or whatever it may be, and also invest into the companies that are building the infrastructure of the crypto market. And Link2 was part of the group that invested into Coinbase pre-IPO. And of course, that did really well for them. Well, you have the opportunity to catch the next Coinbase with Link2. So definitely check them out. It's once again the opportunity to double dip, just like the VCs, just like the hedge funds. Check out Link2, link in the description. Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Greg Dickerson, who's no stranger to the show. Greg, great to have you back on.
Hey, Tony, thanks for having me back. How are you doing?
I'm doing well, despite the markets being crazy and it's just bloody out there. And I want to get your perspective because we've been talking about these scenarios for months and what was coming with the Fed's decisions and so forth. So maybe you can give us, your take on what has taken place over the past, let's say, 72 hours with the markets crashing.
Yeah. So what this is, the Fed leaked leaked a little information out and saying, hey, on that 75-point rate hike that they're going to do tomorrow. And so the markets have been unwinding in preparation for that. A lot of people think all of the rate hikes are priced in and things like that. What you got to remember is the Fed hasn't done really anything yet. They raised 50 basis points last May the 4th, and that really put the rate at 75 basis points. They really haven't done anything. They were still buying mortgage-backed securities and treasuries up to I think April. So as far as QT goes, that really hasn't even started. What they've done is they've stopped purchases and they haven't really started to roll that off yet. So that's getting ready to start. So the market is just kind of unwinding all these things. And of course, the inflation print, because there was a narrative from the government, the Fed, from, the president's advisors, his economic advisors, from academics, and analysts out there saying that inflation has peaked and that it's going to come down. And, I think you and I were saying, and I was talking to everybody else and on my channel, there's no way inflation had peaked. I don't know what they were looking at, and they just couldn't hide that number. So that came out way hotter than what everybody thought. And then the markets also said, wait a minute, that means June, because that was, May's number that we just saw. So June's number is obviously going to be hotter than May's number. And we're going into the summer season when all costs go up anyways, food, travel, energy, all those things. So July and August are going to be hotter than May and June. We could potentially be seeing a 9 or 10% inflation print, coming out by, August, September timeframe, looking back on June, July, August, going into the fall. So that's what the markets are digesting and unwinding. And then when the Fed leaked out 75 basis points, that gave relief. That's why we've found a little base, because what's happened is the Fed's lost credibility, meaning markets don't believe the Fed has a grip on what the reality of inflation is, and they're too far behind the curve to stop it. So if the Fed would have come out and raised 50 basis points tomorrow, they would have now said we're incompetent. Not only have we lost credibility, but we're completely incompetent. And I mean, this is a technical thing that I'm talking about here that the markets are looking at. And the markets would have just collapsed if they would have only raised 50 basis points. So the Fed had to send a signal to the markets. Look, we understand, we got it wrong. We're going to raise 75 basis points, maybe 100. So what'll happen is the same thing that happened on May 4th. And I can show the chart when that happened. The markets popped on the 4th, and then it was a drop of 30, 40% the next day, for the next few days after it was like, all right, the Fed's got a grip. They're going to work on inflation. So we got a nice little rally because it had, dropped up to that point. And then it was like, wait a minute, the Fed had to raise rates, so the market continues to work its way down. So I think that's what we're looking at tomorrow.
Wow. Yeah. To your point, if they come out at 50, it'll show capitulation on their part. And like you said, they don't have control of anything. So they kind of have to come out strong and at least give some confidence to folks out there. But Greg, you've been through many market cycles. We talked about it last time. Have you seen a perfect storm like this where you have crazy inflation, you have, I guess, a recession looming, crypto is getting hit hard with black swan events as well, the Terra Luna collapse, and then stocks are down. And obviously there's a Russia-Ukraine situation. It seems like there hasn't been a situation like this, but I could be wrong. What are your thoughts on that?
No, I mean, there hasn't. Nobody's seen anything like this. This is a unique situation. It's different because, we've seen high inflation before. You go back to the 70s, but, interest rate environment was very different back then. It was already at, higher levels. The difference is we're at zero interest rate. We've had trillions of dollars pumped into the economy by the Fed. We've got a very strong job market. We've got super high inflation. So nobody has seen this. But as far as bear markets, sure, we've seen that. And here's what a lot of people forget. So in the crypto space, a lot of people are, newer in terms of investing in things. So they've never seen a bear market. Now, there's been bear markets in crypto. And by the way, crypto bear markets, crypto winters generally last 2 years or more. So we're in the early stages of a bear market. So just for everybody, this could last another year to 18 months if it's a normal market cycle that crypto has lived in before. But what they've never really seen is a macroeconomic bear market. So you have to go all the way back to 2009 and really 2007, because the market peaked in 2007. It took 2 years to bottom. So that's what people need to hear. In a global macroeconomic downturn, recessionary environment, bear market, it can take 2 years to find a bottom, which is what it took last time. And that was with a major banking crisis. So I'm not saying that's going to happen or can or will or is. I'm just saying in a global, macroeconomic meltdown like we had in 2009, it was 2007 was the peak, 2009 was the bottom, and then it took another 2 or 3 years to get back to where we were before that crash. So it was a 6-year period to get from peak to back to even during the last great financial crisis. This is very different, but the contagion out there, if the Fed and central banks around the world don't get a grip on what's happening with inflation and economic stability, that could happen again, because your credit markets could crash. And the Fed can't do anything about that this time, because inflation will do more damage to the economy than just letting the credit markets fail and letting the markets just tank. So that's what's different this time than the last time, because we came from higher interest rates of 2007, 2009, and even back in the 70s, where the Fed could lower interest rates and start pumping the economy full of liquidity. They can't do that now.
Yeah, it seems like there's much more pain ahead, and on some uncharted waters here. Let's talk about the different assets, whether it be crypto, stocks, and real estate, and how you're planning to navigate each. And if you want to share any charts, you certainly can.
Yeah. So let's just pull this up right here so you can kind of see, what I was talking about. This is May the 4th right here. So this is Bitcoin. On the daily, May the 4th, we had a nice little pump, $1,000 or whatever, went from 37,579 up to 39,900. This is Coinbase price action on TradingView. And then, that was the day of the announcement of a 0.5 point, and then it popped, it dropped 36%. And then we just kind of ranged sideways. And now, this is probably another, what is this drop here? 34%. Mm-hmm. So you could expect some, sideways ranging here, maybe a little pump tomorrow if they raise, but, you could get another leg down after that settles in. And if you see what the market's been doing, it's been kind of working these little levels as it's been dropping and consolidating. We had this big Do Kwon bounce here. This is when Do Kwon was buying all that Bitcoin. That's kind of what pumped and propped the markets here. But once that unwound, then it's just been continuing that, step down pattern, on Bitcoin, and like we saw in Ethereum here as well. So, when I talk about bear markets and what that looks like, here's the Dow. Let's go ahead and put it on the weekly here so you can see, what I'm talking about. and what these things can look like. And, here's 2007 to 2009 right here. This looks pretty nice and quick and thrift, right? But this is, the 8th of October, 2007. This is March of 2009, almost 2 years that the market kind of unwinds. If you look at this price action right here, looks a lot like this right here. Sure. So one of the theories I have is if you pull all the liquidity out of the market, and this isn't going to happen, this isn't projecting, this isn't bearish, this is just, hey, as an investor, you ask me, what do I do? What I do is I think, how am I wrong? What's the worst that can happen? What's the best that can happen? And what's the catalyst for each of those scenarios? So right now I'm in defense mode because we're in an economic downturn and it's defense, it's risk off. So I have to look at what's the worst that could happen. Well, we pretty much know that what makes sense is pre-pandemic levels, but pre-pandemic levels on traditional assets was still, when you look at this, QE started right here, March 2009. Okay.
Right.
That's where that started right there, that QE. I mean, that's pretty parabolic, QE and, basically zero interest rates.
Sure.
So maybe Dow 14,000 before the great financial crisis and, all the QE and zero interest rates started is a realistic level in terms of, what's a real basis if you pulled all the liquidity out of the market and the markets had to completely reset? What's a realistic level? Well, the pandemic, pre-pandemic, I mean, that was a big run up to that point. I mean, that's pretty parabolic right there, when you look at it over the years in terms of the gains. So maybe, this 2018, the last time the Fed pulled the plug, said we're raising rates and we're pulling QE, out of the market, we're going to stop QE. So that's right here. And that was Dow 26,000. That was huge record valuations and record levels right there. So let's take a look at what that is. So that is a drop. Pre-pandemic is a drop of 20%. 2018 is a drop of 27%. And then if you go back to 2007, that's a 61% drawdown. Okay. That might sound like a lot. And it might sound like, man, that's not even possible. This guy's nuts. And I'm not saying this is what I'm thinking. I'm just saying what could happen.
Sure.
All right. Well, in 2007, price dropped 54% over 2 years. Okay. So where does 54% put us? So let's say we get a 54% drawdown. That's Dow 17,000. Not too far away from where we were pre-2009 great financial crisis. So from a worst case scenario, that's what you could see happen potentially if you pulled all the liquidity out, the Fed couldn't do anything and markets had to completely unwind all that price action. So the next question is, what does that look like for Bitcoin? And, you can see with Bitcoin, it's about $3,000. Those levels that we're talking about, because, it didn't exist in 2009. The worst case for Bitcoin that it didn't go below was basically, it's held that $3,000 level. So if it worst case scenario, all the liquidity is gone, everything's unwinding, institutions can't come into the space because they can't come into the space given the current, financial climate right now. We're not going to see a ETF get approved right now, especially with what's going on with Celsius and all that kind of stuff. Those are the catalysts you need for that next leg up and to kind of reverse. You need the Fed to pivot, to stop. You need inflation to come down. You need the economy to heal. So let's say those things can't happen. I could see, that level coming back into play, and that's where your consolidation happens for a while until the market heals and everything recovers. And then you can get another 20x, or 30x or whatever Bitcoin's going to do the next time it does its thing. But what's realistic right now, and this is on the weekly, everybody's watching that 200-week moving average. Yep. We're right there on it right now. The other thing I look at is the Gaussian channel. And you can see it just started turning red. And, generally when that happens, it stays red for about, somewhere around 6 months to a year. So it's just now started happening. So this is telling us we've got some time to play in these zones. Sure. The other thing that I look at that's really interesting too is, let me turn this off here. The Bitcoin hash ribbon indicator, the buy signal. And the last time I was really looking at this was last year, when we were dropping, looking for that buy signal, for the top. So this takes the hash rate and the moving average And when the hash rate drops below the moving average, it's the capitulation of the miners. So we look like we are right in this area right here, where capitulation, the real capitulation just started, right in this area here. That's what it looks like right now. So from the time that signal stopped to the bottom was about 27% drop. So if you come over here and you look at what this signal is looking like right now, and you see where it flashed, and you go and measure that 27% move, we may be close to it right now. Oops. And let's take a look at that. Yeah, we've already dropped, 29%. So, there is some, information out there that could say this could be putting in a bottom here because you're on the 200-week moving average. You've got the Gaussian channel turning red. It could stay red. And, the Bitcoin hash, ribbon indicator, showing that this is capitulation for the miners right here. So, these are some of the things I'm looking at in terms of, where's price action right now. But at the same token, we've just been level to level, where you get these bounces, Bitcoin bounces, consolidates, takes the next level, bounces, consolidates, and is there going to be a next level? So I think as long as the, macroeconomic environment continues like it's continuing, we have to expect more downside. We have to expect that 20,000 level to get tested. And if that doesn't hold, we have to expect 10,000 to get tested because that's where your next support is. There's not really any support between where we're at on Bitcoin now and 20,000. We're in that $23,000, $24,000 area where we had a little bit of support last year in that, we're actually in 2020. So that's what I look at from the standpoint of risk assets, markets, Bitcoin, those types of things. What's my worst case scenario based on history of an economic cycle where there's no Fed? What does that look like? And then where can we go based on where were we and what's going to get us there without the Fed pumping money into the economy and, dropping interest rates. And for crypto, that's going to be an ETF. That's going to be significantly new capital coming into the space because everybody who got in the last year, they're gone. They don't have any money left. Yeah. So they're not coming back ever, until they recoup. Or big institutions jumping in at scale. And with what they're dealing with in the traditional markets, they don't have the, powder to do that right now. They're still trying to hang on over here. So they have to recover over here before they can redeploy in this area. They're not going to convince their investors to get into crypto right now. It ain't happening. So they're pulling out. They're trying to shore up over here to weather this storm before they can get back into crypto at scale. So that leaves the VC space, and they're pumping into companies and projects, not assets.
Right. So I know you're more of a trader, and are you kind of much more in a holding pattern now? And when do you think you might turn bullish and say, you know what, we hit the bottom and I'm going to buy up here and then get ready to sell and make my profits, depending on the bounce up?
Yeah. So I'm waiting for, number one, inflation. So that's your biggest indicator right there. So for everybody watching, the time to be bullish is when inflation's under control and the Fed can stop, not necessarily pivot. All they got to do is stop. And once the Fed says, hey, we're done, we don't have to raise rates anymore. And, wherever they're at with QT based on what they say after this next meeting, that's your buy signal. That's when markets are going to be off to the races for a while. And, it can be bull market back on. But yeah, I wait for, in the stock market, I've been picking off little stocks here and there that have been dropping like 50% in a day. Sure. I'll jump in and I'll, get 20% out of those and then I'm done with it. As far as crypto goes, same thing. I wait for these levels to get hit and then I'll buy something at the bottom of the level, maybe sell at the top and just get, 20, 30% out of that. So, I've been playing and doing those types of things, but I'm not long-term anything right now because without the Fed stopping, you can't expect the markets to reverse course.
Sure.
Yeah, we'll get some big bounces, but not a complete, reversal of the markets. No new all-time highs. That's just not even that's not even reality. That's not realistic. And I know there's a couple of people talking about looking for a retrace in an altcoin season. That happened. That was last summer. When that retrace happened, it was an irregular correction. That's when alt season happened. It wasn't all of them. It was most of them. Sure. So, that's over. We've missed that train. So now we have to, wait for a new cycle.
I know that's painful news for some because I know some folks, even including myself, last year I was looking for certain coins to pop off, but it certainly didn't happen. I think your thesis is correct. The way it played out, and that could have been the retracement. And even though it went a little bit above Bitcoin, at least, made a new all-time high. It was just a small amount of money that it went higher than the previous high. I think that might have been it, because
and altcoins were running. I mean, most of them ran during that period. So I was watching it during that time, going, man, because usually they all go, and I'm like, is this alt season? Is this, and it was happening. You had DeFi summer before that. You had Metaverse. So it rotated just like it always rotates, but it was such a weird thing. It caught everybody off guard.
Yeah.
And then everybody's thinking, well, 69 is the top. And we had a retrace there. We had that little bounce. It didn't quite get that high, but I think it was a 50% retrace. And some of the altcoins have run. So, I mean, it just kind of is what it is right now. With the Fed out of the game, I think that's the biggest revelation for people in crypto. I was talking to somebody earlier, is like, man, I just didn't know how important the macroeconomic environment is to crypto, and the Fed and stimulus and all of these interest rate environment, how much that impacts and affects crypto. And when you think about it, it impacts and affects everything. The real estate market, you as a consumer, because it affects your borrowing ability. So it really affects everything. So you really have to watch it. There are some nuances and differences in crypto because it is a network effect, but the network effect is you got to have people with money coming into the space confidently. And when you're coming off of what's happened and so many people getting burnt and so many things going wrong, it takes a while for that confidence to get renewed, new people to come in. And that's why you have these cycles, and, that's why it ebbs and flows, because they come in, they get burnt up here, they're out, they lose all their money. You got to get new people in to replace them, or they have to be able to recover and ride that second wave up. So, that macroeconomic, climate and indicator out there is extremely important, because crypto is risk assets. And, there are a few projects and tokens here or there that, are going to do their own thing regardless of what's going on, in the macroeconomic environment in of itself. Just like there'll be individual stocks, the whole market might be tanking. There might be one or two that do okay. But in general, it's all liquidity. And these are risk assets at the end of the day. It just is what it is.
Yeah, absolutely. Let's talk about real estate. That's, obviously your forte. Obviously interest rates are on the rise. Home valuations, I believe, have been dropping. What are you seeing in your neck of the woods and maybe across the nation as well?
Yeah, so the market's starting to correct. It's starting to slow down, and interest rates they're rising a lot faster than I ever thought they would or could. So we're just about to hit 6%. You're going to see the brakes on the real estate market big time here real soon with 6% interest rates. Summer's always slower anyways in the United States. In most areas, that's your slowest selling season. So you'll see, and we're already starting to see it, inventory levels are rising in a lot of areas. Real estate's hyper local. Every market's different. But we're seeing inventory levels rise across the country. We're seeing asking prices come down, price reductions. We're seeing deals fall through. We're seeing traffic way down in open houses, builder communities. The home builders are not starting any new projects. They're pulling back. They're struggling to get buyers for what they have. They're having deals fall out, which are where the best deals are going to be right now, by the way, is going to be builders, because they have to sell and they will sell. They'll take a loss to get rid of inventory, whereas, existing homeowners that are, in a house that have a good mortgage that they capitalized on the last couple of years, they don't have to sell necessarily. So they can wait it out. So new home communities is where you're going to get the best deals right now. And resort markets, you'll see resort markets correct and inventory start to stack up in those because they're all about cash flow. So with prices where they're at now and interest rates, they don't cash flow, and nobody's going to put 50, 60, 70% down generally if they're looking for a cash flow property, because the numbers don't work in terms of cash on cash. So, and that's commercial, residential, the entire real estate market's correcting all across the board. So, but it takes more time. It takes about, 6 months to see real correction in real estate markets versus, assets that'll happen overnight.
Right.
Stocks, bonds, cryptos.
I don't know how much you can share on this, but with the real estate market, the scenarios you mentioned there and what's happening, now, how does that affect rent prices? I don't know if you dabble in any of that, but would we expect to see rent prices go down as well?
So again, that's a demand thing. So right now there's a lot of demand for housing and rentals, and rents have gone up exponentially. That's one of the big inflation numbers. Well, they're not really measuring it correctly, but rents have gone up 20, 30, 40% in some markets, especially in South, the southern areas, Sunbelt areas. So as the cost of ownership of properties goes up, if you have adjustable rate, products on investment properties, well, you have to raise the rents to help service that debt. Sure. But you can only raise rent so much where people just can't afford it and they'll move. And that's already starting to happen. You're seeing it on the news every night, people moving because their rents are too high. So that will potentially correct, in and of itself. But it's all about supply and demand. If there's no inventory, it is what it is. If you want to live in New York City, you got to pay the rents, So it boils down to, what the individual wants to do. But if they can't afford it, they'll move. And that's what they have to do. So that is a little bit outside of the general value equation in real estate based on interest rates. It's more of an opportunistic situation where landlords are taking advantage of, limited supply in their areas and rent and big demand, and have been raising rents exponentially on people. And I mean, there's been crazy stuff. I saw a story last night on the news where somebody's rent went from, I think it was $4,000 to $6,800. Wow. Overnight, the landlord sent a letter out, and hey, we're raising the rent on this house to $6,800 from $4,000. That's just crazy.
Wow, that is crazy. Any advice that you have for, and you did kind of sprinkle some of this in as we've been talking, for first time investors, whether it be stocks or crypto, how to navigate over the next 6 to 12 months?
So learn. This is the time to learn, to understand how to manage risk. And if you can break even or make money in this environment, you're going to do extremely well in a bull market, because anybody can make money in a bull market. You just buy and you hang on. And that's what everybody's pretty much used to. Not everybody, but most of the people in crypto, that's worked. That's been a great strategy. Just buy and hold. In a down market, that doesn't work, right? It just goes down. And, there are no guarantees that it's ever going to go back up, or to what level. There's no guarantees. So we know where it's been. We know what's possible. Again, you got to question, what are the catalysts for that? But the biggest things are, number one, educate yourself. This is a great time to learn. It's a great time to practice, do paper trading, use a small amount of money, make your mistakes now with a small amount of money so that you're ready when the market shifts. Keep your bulk of your liquidity and your assets available to take advantage of the market when it does shift. And always question yourself, how am I wrong? If I'm going to make a move, I'm going to buy this property, I'm going to buy this stock, buy this crypto, risk reward, what's the worst thing that can happen? What's the best thing that can happen? What's my exit plan? And, how am I wrong on my assumptions? And everything I've said earlier, I can be totally wrong. But these are the things I'm looking at to help me manage risk and make investment decisions. So I know what my upside potential is, my downside potential is. And what I'm looking for is, how can I be wrong on the downside? How can I be wrong on the upside? And, watch the Fed, watch inflation, and watch the Fed. The Fed is your buy signal. As soon as they say we're stopping, we don't have to raise rates anymore. Inflation is stabilizing. Don't listen to what they say. Watch the inflation report. Yeah, because they said it tapered as well, and they thought it had peaked. But once we know that inflation is stabilizing, and everybody knows, when gas comes back down, when food starts coming back down, and economies open back up, and things like that, that things are getting better and inflation is coming back down. That's going to be a good indication that the Fed can pull back, and we can start getting ready to reload again. So those are the things that you really want to do. The biggest thing is educate yourself. This is the time to learn. This is the time to practice. Don't check out. Don't get bored. That's what I did the first 3 years that I learned about Bitcoin. I watched it go up and drop, and I was like, and I didn't pay any attention to it. If I would have only educated myself further back then and learned, man, I could have turned, what I had into billions easily, but I just watched it go up and drop, and I just lost interest. And that's what's happening right now. People see that and they just like, I don't want any part of that. And they don't educate themselves. So you really have to educate yourself on these moves. I was fortunate enough in the markets. I got in 2009 in the stock market at the bottom. I had a good friend of mine that told me, he said, man, this is a generational opportunity. And I was like, well, can it go to zero? Because it looked like it was going to. Sure. He's like, no, man, it ain't going to zero. And so I got in then, I educated myself. I made some really good moves. And then I did it again, in the pandemic. I did it in 2018. I did it in the pandemic. So you want to get these bottoms, and be ready to make the right moves, educate yourself, and have the powder, the financial, capital available to take advantage of those moves when they do happen. And then be okay with getting out at a point and missing on a little bit of upside if you do.
Sure.
If you got 1,000x return, over the last bull run at this last peak, and you get out and you miss on another 100%, do you really care?
Yeah.
Are you really going to care that you missed 100% when you got 1,000% return?
Yeah.
Given where we are now, you're not going to care.
Yeah.
Markets always ebb and flow. Good times never last, bad times never last. So this is not going to last, but it's going to take some time.
For sure. Greg, great advice. Always a pleasure chatting with you. Thank you so much for joining me today.
Yeah, man. Thanks for having me. It was good chatting with you.